Why would I want to go?
All right, can you hear me on Zoom? Great, thank you.
No, that's legit. Okay. No, there's a guy behind who's I thought it was the same guy. Might have been. And no, I don't think so.
All right, so let me get started just to, so people on Zoom can hear what I just said. I'll go over the exam on Wednesday. Again, I just need to tie up a couple of loose ends, hopefully by the end of today, so then I can go over it on Wednesday. I'll give you some of the numbers that I have so far, and I don't believe you can see these on Canvas, right? If you take the exam on Canvas, then you can see all the statistics, but you can only see your own score. Is that right? All right, so the average was 76%. I think it was 21.4 around there out of 28. So 76%, that's not bad. That's pretty typical for exams. 16% standard deviation. That just means there's pretty big variance. The high was a perfect score. There were a number of people who did well, and I'd say well is like, I'm talking about like 23 and above. I think that's probably over 80%. So a lot of people in that range. So a lot of people did well. So anyway, those are preliminary statistics. Like I said, a couple of loose ends to tie up, but that's pretty much it. So that's pretty good, 76%. It's always nice to see higher. I have a little more flexibility in terms of curving this class because it's a 400 level class at the end. I usually wait till the end and see if I have an opportunity to curve, but at a 76, most people are going to get very high on the homework, a high percentage on the homework, so that helps, but 76 for a class like this is going to give me some flexibility to curve at the end, which is good. All right, any questions on that? Again, I apologize. I just got to wrap some things up today and I'll be able to go over it on Wednesday. We can just pull it up and we can run through the questions so that everybody's clear on that. All right. Sorry, I know that's kind of disappointing. Most classes, the day after an exam, nobody shows up. I don't know what that means. Yeah, a lot of them, it's like there's a big drop off. So that's for recovery. Yeah, it's sort of like, you had to work into it for the exam and you get through the exam, it's like, I need a break. They step back. It's very, very common. All right, so let's move on. Again, on Wednesday, Wednesday, I'll give you all the details. We'll run through the exam quickly, especially any problems that were trickier or more people missed. But I think we can pretty quickly go through the whole thing. But we'll plan on doing that on Wednesday. All right, so let's jump back into the material. We got through chapter 7. We did 6 and 7. Again, I don't know how many people are following along in the book, but if you are following along in the book, we went through the strategies. And now what we're going to do is we're going to hit the theory. So we're going to go back. If you are following along in the book, we're moving back to actually chapter 3. I don't want that color. And we're going to pick up the theory. So chapter 3, principles of option pricing. And I'll give you a little bit of the background. I always like looking at the history of some of this stuff. And option pricing is particularly interesting. And later in the semester, remind me, I'll post a video, which is actually well done, about the history of option pricing theory and Black-Scholes and some stuff that happened after, which is very, very interesting. I might do it in early November. I think I'm on jury duty in early November, so I might have to, it's probably a good time to do that. But that tells some of the history of this stuff. So just a little background, options, they were around in sort of the late 60s. What was going on in the finance world in the 60s? You had CAPM, Sharpe came out with the CAPM, I think in 65. And one of the big problems to tackle was option pricing. At that time, they weren't exchange traded. They were called warrants, but they're essentially the same as an option. And so some of the big names were, everybody was going after this problem. It was like, this is the one to solve. And then the ones who cracked it were Black and Scholes, of course. And they cracked it open. So we're eventually going to get to the Black-Scholes formula. But we're going to start a little more slowly. We're going to go through some of the properties, and then we'll see their big contribution that they eventually got the Nobel Prize for in, I think, 97. Actually, Black had passed away, Scholes, and then Merton was a big contributor to that. So some of these names, when I show you the video, they're going to play in pretty prominently to the whole thing, because there was some interesting stuff. I don't want to give away the video if anybody knows the history of what happened. There's actually lots of very interesting backstories related to the Black-Scholes formula. But the one in the video has to do with what happened with Scholes and Merton. They were involved in a big hedge fund, which was like the dream hedge fund, because these were like the big Nobel Prize winners. And then you'll see what happened there with their hedge fund. I don't know if anybody knows the history. Is anybody familiar with that? Good. Then you'll like the video. There's also other interesting history. I gotta watch out. I get too far afield talking about this, but the Black-Scholes formula, there's somebody else who's well known in the hedge fund world, especially for people who study the history of it, who supposedly had the Black-Scholes formula and was using it prior to Black and Scholes. And this was Ed Thorpe. Does that name ring a bell to anybody here? There's a chance that it might. It depends on, you're going like that. Ed Thorpe. Is anybody a card counter at blackjack at 21? No. Some of the time somebody will be, a card counter into gambling. So if you are into gambling, then everybody well, not everybody knows, but Ed Thorpe is very famous. He wrote a book called Beat the Dealer. This was the first book showing that you could count cards and you can get an edge over the dealer. Okay, so he was actually like a statistician. He was a statistics professor at UCI. So I believe he probably still lives, he's pretty old now, probably late 80s. He still probably lives in Newport Beach. Anyway, he was famous for that. So very, very smart guy, into gambling. And there are lots of similarities between gambling and investing. right? Because you're dealing with a risky outcome and how do you manage your risk and everything like that. Anyway, very, very smart guy. So he's famous for that in gambling worlds, for Beat the Dealer and card counting. He's basically the father of that. He also has another book, less well known, called Beat the Market. Okay, so after some of his card counting escapades, if you will, he started a hedge fund, Newport Princeton Partners. Fabulous track record. Okay, so starting in the late 60s through, I think he retired in 2006, never had a losing year, compounded at over 20% per year. Just unbelievable record. Okay, just extremely, extremely good. So he was the one that people claim had the Black-Scholes formula and was using the Black-Scholes formula actually to make money prior to Black and Scholes, prior to them publishing it. Which is kind of interesting because then there's been controversy over that. Not that there's really controversy, but people like to argue over stuff. So anyway, there's been some controversy, like who really deserves the credit for the Black-Scholes formula and whatever. So interesting stuff if you like to read about things like that. Some of the time when I teach this stuff, I like to go look into the background, and some of it's really interesting, especially a guy like Ed Thorpe, who did a whole bunch of really neat stuff, not only in blackjack, but if you're into gambling, he also looked at roulette wheels. It's like, how can you beat a roulette wheel, right? He, along with actually another very famous academic, a guy by the name of Claude Shannon. Does anybody know that name? You wouldn't know that in finance, but everybody in like electrical engineering would know the name Claude Shannon. He's the reason your cell phone works and stuff like that. He was a guy at MIT, very eccentric, but very smart guy who did what they call information theory. He and Ed Thorpe, they actually got a roulette table in, I think, Shannon's basement, and they were doing these measurements, like if it's tilted just slightly, that skews the wheel, and it actually skews the probabilities. And so you can actually, if you can measure that, you can actually like perhaps beat a roulette wheel, because the people who spin it are very consistent when they throw the ball, and it's like a slight tilting. And they actually built, this was way, way back, a computer, because Ed Thorpe, he had been at MIT before going to UCI. And there he was working on like their supercomputer. He was a smart computer guy as well. They built a computer to stick in their shoe to both do card counting and calculations for a roulette wheel. And they went to Las Vegas to do this. And then the computer broke very early. But they were doing a whole bunch of crazy stuff. Just really, really interesting things. So anyway, lots of neat background on this subject. When I do post the video, you'll get to see sort of the more traditional Black-Scholes and Merton, those big names that are associated with this, what happened to them and what they did. Very, very interesting story. All right, so enough of that. I can easily get sidetracked talking about that stuff, but I think it's interesting. Let's get back to here. So we're going to develop this theory. We're going to start very simple. We're not going to immediately get to the Black-Scholes formula. We're going to start just by looking at some of the theoretical properties of options. And in this chapter, chapter 3, we're going to hit put-call parity, which is sort of our big first result, simple result. And then we'll eventually, in the next chapters, finally end up at the Black-Scholes formula. So we're going to start simple. Let's talk about basic properties. And the idea here is, in the previous chapters, what we went through is, what are the different strategies that you can use and stuff like that? How do you want to use it practically? Now we're going to go back and look, and we're eventually going to get to what's a fair price for an option. We never asked that before. We just said, here's how you can use them. We eventually want to get to the notion of how much should these things be worth. And so what people started with is very simple things, like what are some basic properties they should satisfy, and we'll see, we'll build it up for there. So we're going to start with the European call options. Okay, so I'm not going to have early exercise. That just complicates things. At least right now, I'm not going to talk about early exercise. And very simple properties. So let's start with the first one here. So the value of a call and this is very, very simple, is decreasing with increasing strike. Now, this should be pretty intuitive, right? We're going to see some of the other ones are not as intuitive, but like I said, they started very simple and just said, what are some basic properties that must be satisfied by options? So the value of a call is decreasing with increasing strike. Why is that the strike? Again, think of the coupon analogy. The strike is how much you can buy it for in that coupon. And obviously, if the strike is higher, the coupon's not as good. Doesn't give you as low of a price, right? So the value of a call is decreasing with increasing strike. I'm going to try to get you, again, as we go through this, to think in terms of the payoff diagrams. So, and this one, you don't need this, but I think it's helpful to get us always thinking in terms of payoff diagrams, especially when we get to so-called put call parity. So look at the payoff diagrams. Okay, so the payoff diagrams is pretty straightforward. So remember S sub t, and I'm going to have strike one, and maybe I'm going to have strike two, and I'm going to do the payoff. And I have two different calls. So here's call number one, and then here is call number two. And I'm just doing their payoff. And we all remember what this formula is, right? So this is max 0 S sub t minus x1. But remember the payoff is just what you are purchasing. Remember the cash flow diagram. There's C sub t, C0. The payoff is just payoff is essentially what you are purchasing. All right. So why, when I look at the payoff diagrams, how can I see in the payoff diagrams that lower strike should be worth more? Okay. Now I said this one, you don't need to do this intuitively. The lower the strike, it means your coupon is better. It's a lower price. But here, what would we look at? Let's look at the payoff diagrams. And if I look at the payoff diagrams, what do I see? No matter what the stock ends up at, the red line is always greater than the green line, right? It's always above it, which means the red option, that's the one with the low strike, always has a higher payoff than the green and strike X2. Something that always pays off more than something else should be worth more. Make sense? Okay, and so I want you to get you thinking along those lines because we're going to use this, like I said, when we eventually get to put call parity. But here's the idea. So the price here, well, actually, I'm just writing it down in notation. So C01, which corresponds to that, must be more valuable than C02, right? If X1 is less than X2. That's all that's saying. And this assumes they both have the same time to expiration. Okay, so I'm starting here. I'm just going to be looking at call options. Let me highlight that. I'll jump over to put options later. Let's just go through call options. So the first thing is we're going to look at strike. How does strike affect their value? We're going to look at time to expiration. Okay, so let's do effective time to expiration. And first, I'm going to assume, you're going to see things begin to get trickier. Assume no dividend. Okay. So let's highlight that. First, I'm talking about no dividend. So no dividend. So the value of a call, talking about a European call here, is what do you think? Longer time to expiration, should a call be more valuable or less valuable? Intuitively. More time to expiration. More valuable. The value of a call is increasing with increased time. It's supposed to be time to expiration. Is this intuitive to everybody? The longer time to expiration, it's sort of like the more chance the stock has to go up and end up above the strike price. So the more valuable it is. Now that's with no dividends. So let's look at, what do you think about when the stock pays a dividend? Okay, so let me highlight that this is a separate case from the one right up above. This might not be true. Can you think of why it might not be true if a stock pays a dividend? That more time to expiration might actually make it less valuable. Again, this is for a European option. Let me give you the example. A stock is moving along here, and let's assume that it pays a dividend. Okay, so it goes ex dividend. What typically happens to the stock price when the stock goes ex dividend, when it pays the dividend? Does anybody know? It goes down, and it's going to jump down by what? By the amount of the dividend, right? So you can imagine that if you are thinking about buying a stock and you're buying it one day before the dividend, and there's going to be $1 dividend that's going to be paid. And so you're looking at the price, maybe the price is $50, and then you miss it, and the next day, are you still willing to pay $50? No, you just missed $1 dividend. So you're probably only going to be willing to pay what? 49, right? Because they just paid out that dividend. So stocks, when they pay a dividend, they tend to drop by the amount of the dividend, right, on the ex-dividend date. And so you can see what happens here. If the stock pays a dividend, let's say your expiration date, you're comparing two different expiration times. Let's call this T2, and let's call this T1. You might think, hey, wait a second, this stock pays a really big dividend. It's actually better for me if it expires at T1 than if it expires at T2, right? Because if it expires at T2 and it's a European option, so I can't exercise early, that dividend is going to cause it to drop right before it expires. Everybody see that? And that might take it out of the money. So when a stock pays a dividend, there's no set rule. It might be more valuable, it might not. It depends on that timing. Okay, let's put a note here. I'm up above, the result is for a European option. What about for an American option? So for an American option, what do you think? more time to expiration, more valuable. It's always going to be more valuable, right? All right, so this is for call options. Let's do the same thing quickly for put options. Okay, and I'm dealing with European put options here. And let's look at the effect of strike. And what are we going to have? Put option. This is the easy one, looking at what the strike does. The put option is increasing in value with increasing strike. Because a put allows you to sell, gives you that option to sell. If it has a higher strike, that means you can sell for a higher price. That's more valuable. Again, I'm going to try to push you to begin thinking in terms of these payoff diagrams. If I have in X1 and X2, and these are put options, then I'm going to have, I wanted a red there. Put option is going to look like that. That's at the high strike. And then I'm going to look at the one at the lower strike. And it's going to look like that. Which one always pays off more? Yeah, the X2. It always pays off more. Right? It always has a higher payoff than the green. So it must be more valuable. Okay, so this one we would say, if I look at the price of the one with strike one, so that corresponds to that. And I compare that to the one with strike two. And higher strike is more valuable. That's pretty straightforward. All right, and then let's do time to expiration. All right, and it turns out that this one, for a put option, there's no clear rule. So longer time to expiration may make a put more or less. There's no rule here. You don't know which one. More or less valuable. Okay, so there's no rule. And the intuition behind this, you should look at these and think about what the intuition is here. This one's a little bit more, a little bit trickier. At least I have a tougher time with the put and the intuition. So a put gives you the option to sell, right? So instead of, compare that to selling now. So if I sell immediately, what do I get? I get cash for the stock that I sell, right? So when you sell, you convert stock into cash. And what is the advantage of holding cash versus a stock? Or what are you going to trade off there? Cash, you've got the interest rate, the risk-free rate, versus the stock, you got the stock can potentially go up, right? So what this says is if I have a put option, a European put option, I have to wait to sell, right? I have to wait to the expiration, then I can use it. But I've got to wait. What am I missing when I'm waiting? I'm missing holding that cash, earning the risk-free rate. If I could sell right now, then I could convert it into cash and I would earn that risk-free rate. So this one, there's a balancing act, and that's why there's no rule. It depends on interest rates and whatever. So it tends to be, if there are very, very high interest rates, then time to expiration being longer might actually be a bad thing, because it's saying you have to wait. You're not earning the interest on the cash that you could get by selling, and so you're foregoing that. Anyway, it's good to think about the intuition. Some of it is a little bit tricky. All right, so this is the first thing. You know, again, you step back, people saw these options and they began to analyze it, like what properties should these things have? Are they more valuable with more time to expiration or less valuable, whatever? And so those were the basic questions they began to address. What I'm going to do next is I'm going to hit sort of the big result in this chapter. And the big result is called put call parity. And this is sort of our first, I won't call it a pricing formula, but it's a relationship that must be satisfied among calls and puts. And so this is going to begin to step us toward a more complicated theory later. But put call parity. And before I do this, let me give you a little bit of background. And I'll show you the way I'm going to derive it. This is different than the way they derive it in the book. I like to do it very graphically from payoff diagrams. But let me remind you of some things. So put call parity, these are just reminders. Okay, so here are my reminders. What is the payoff of one share of stock? What does that look like? I'm just going to draw a little picture here. Anybody remember the payoff diagram of one share of stock? There you go. Yeah, it just goes up like this. It's slope 1. And this is 0 here, and there's my payoff. Okay, so hopefully everybody remembers that. We saw that in things like a covered call or the protected put or whatever. All right, so this is, I want to actually highlight this, of one share of stock. Here, what's going to come into play is also a risk-free bond. So let's talk about that for a second. And let me remind you of what that looks like. So let's look at the payoff of a risk-free bond. And again, I'm going to call it the bond or whatever, but what I'm talking about here is really more like a money market account. It's a security that has no risk, but you're earning interest. I'll often call it the risk-free bond, but it corresponds to a constant interest rate. And I'm going to assume that the interest rate is R. So it's going to be earning R. And so let's look at the payoff of a risk-free bond earning R with face value, or sometimes called the principal of a bond with principal X at time capital T. Did we talk about this before, once before? What the payoff function of a risk-free bond would look like? Let's go back to our definition. This is going to be important here. Our definition of what the payoff function is if I look at a cash flow diagram and time T, it's the cash flow that you get at time T. So for a bond, the cash flow that I'm going to get at time T, and I'm just going to call this B sub T. For a bond, cash flow that I get at time T, I'm going to assume no coupons for this bond. This is the simplest possible cash flow, just a risk-free cash flow that's going to pay an amount X at time capital T. Okay, and then there's a price for this, B0. And how do I calculate the price of this? If I give you a risk-free security, it pays X at maturity, and I ask you, what's the price of this? And the interest rate is R. So you said at present value. This is where we go back to, like, I don't know, was it 320 or whatever? We go and we just calculate the present value, right? That was for risk-free things. Use the risk-free rate. You just calculate the present value. So, so how do I calculate the price of this thing? It just B0 is just the present value. So I'm going to call it the present value of X. X is the amount that I'm calculating the present value of. And by the way, I have to tell you the compounding convention that we're using. So I'm going to be consistent with the book. It's the easiest convention. It's annual compounding. So the way we're going to calculate present value with the interest rate that they give us is just X over 1 plus R to the T, where T again is measured in years. R is an annual interest rate. T is measured in years. I'll write that down in a second. But another way to write this have you guys seen it written like that before? I'll do 1 plus R to the minus T. So that's just using the property of a negative exponent, right? If I move it into the numerator, I can use that negative exponent. So some of the time I will write it that way. I like to write it that way. Probably in your other classes, what do you see it written like this? Yeah, so either way, that's the same as this. Later, I'll tell you why I like to use this. I like to use this because I'm pulling a cash flow backwards in time. And so that tells me how far backwards I'm pulling it in time. I sort of scoot it back minus T in time. Anyway, we can do it either way. So this is the price of the risk-free bond. We just calculate the price of a risk-free bond by calculating its present value. Okay, let me put down some of the details here. R is annual compounding. Okay, and that just means we're going to use 1 plus R to the T as our discount factor. And so T is measured in years. So this is very simple compounding here, right? Because 1 plus R to the T, that's it. T is measured in years. T doesn't have to be an integer. It could be half a year. In fact, in most of option pricing, it's very short time to maturity, a month, 2 months. So it's going to be a fraction of a year. Are you guys familiar with this? In 320, I don't know, do they go through different compounding conventions? You guys remember? Yeah, so this is the simplest. So the way we discount or compound is just 1 plus R to the T. Okay. Okay, everybody's comfortable with that. All right. So this bond here, what is the payoff? What is the payoff function of a bond? Somebody tell me what it should be. The payoff function of a bond. Now remember the payoff function is just the cash flow that you get at expiration if you purchase this thing. It's just a straight line at X, at whatever X is. Okay, so I'm gonna make this red. So this is it. At whatever the face value is, it's just the amount of the face value. Or the principal, if you're familiar calling it the principal. All right, so maybe this is the one we haven't worked with. We haven't worked with yet, but we'll need this as well for our put call parity. Okay, so what we have here is this one here. This is the payoff of a stock. We can do the payoff of a stock. We can do the payoff of a bond. We're going to use that. We can do the payoff of a call. We can do the payoff of a put. Okay. And these are preliminaries. Let me put down put call parity and then I'll derive it. And then you'll see why I went through this and reminded you of these payoffs. So this is sort of our first big result here. So I'm going to underline this in red and also highlight it, put call parity. And the formula is the important part. But first I'll tell you in words what put call parity is saying. It's going to tell us the following. And it's going to be only for European. Okay, so European puts and calls with the same strike X and expiration T. So you pick an expiration, pick a strike, and there's a put and a call there. Okay. And we're talking about on the same stock. S, I'm going to call the stock S, are related by a formula. And here's the formula. This is what we call put call parity. And let me, just to be clear here, let's assume for right now, no dividends. Later we'll do it for dividends. Assume the stock is non-dividend paying, just to make that clear. And here's what put call parity says. It says the price of the call, and I'm using the shorthand notation again, price of the call minus the price of the put plus X over 1 plus R to the T, T is time to expiration, must equal the price of the stock. So it's a pricing relationship. I'm gonna double do this, stick a star by it. Really important formula. I'll go through, I'll derive this for you. And the derivation I think is useful. And I'm going to do it with those payoff diagrams. But basically what this says is it says, look, if I'm looking at a particular strike and time to expiration, if I know the price of, say, the call, then I know the price of the put. They're not independent. They can't be separate. If I know one, I know 100% the other. Okay, so that's kind of interesting. It says calls and puts cannot be independently priced if they're at the same strike and same expiration. They are not independent. You know the value of one, you know the value of another, and they must be related through this formula. All right, let's prove this. All right, here's what I'm calling our proof. I'm just going to argue through what we're doing here. Okay, and the way I'm going to quote unquote prove this is, let me tell you the principle that's that we're going to follow here, and this is we're going to call this absence of arbitrage pricing. But the principle here is that, let's see if I can get everybody to agree on this before I go through the argument. Two things that have the same payoff function must have the same price. Do you agree with that? If I look at their payoff function and two things have exactly the same payoff function, they must have the same price. Why would you pay more for the same payoff? Does everybody agree with that? Because that's the principle. It's sort of like this. If I have two bags, and in one bag I have a share of stock, and in another bag I've got, I don't know, maybe it's a portfolio. That's what we're going to do here, but it has exactly the same payoff as a share of stock. Then if I'm going to sell these to you, I must sell them at the same price, because both of them just pay off exactly like a share of stock. And you don't care what's in the bag. You don't care how it's made up. You just care that the payoff, well, it's going to be equal to a share of stock. I don't know if that was the best argument, but basically you don't care how something is created. You only care about the payoff. The payoff is the cash flow that you're buying. Okay, hopefully everybody buys that. All right, then if you buy that, let's go through here. Let's see how easy put call parity is. So let's go, and we're going to start with the payoff diagrams. Okay. And I'm going to show you that there are two ways to create the payoff diagram of a share of stock. What's the first one? What's the payoff diagram of a share of stock? I reminded you of that. It was that, right? With a slope of 1. Okay. So that's method number 1. I want to give myself more room. Okay. I'm going to make it big like that. All right. So that's number 1. That's the payoff of a share of stock. So here we go. This is my 1 share of stock. Okay. What if I tell you there's another way to create this exact same payoff? Let me show you how to do it. Then I'm going to have two things that have the same payoff. Two things that have the same payoff must have the same price, right? That's what I'm going to do. All right. So let's go. Let's look at these options with strike X. That's what we're talking about here. And here's what I'm going to do. I'm going to buy a call. What's the payoff of a call? That, right? So that's the payoff of a call. So let's write this down. So this is 1 call. Everybody's okay with that. You haven't forgotten that yet, right? From the exam. It's easy to forget things after the exam, but this one. All right. I'm long a call. Now I'm going to go and I'm going to short a put. What does shorting a put look like? So if I were long the put, it'd look like that, short the put. So let's do that. I'm going to short the put. I'm going to come over here. Here's my put. And this is the payoff from shorting a put, right? So I'm -1 put. They're both at the same strike X, right? I want to get the angle just right on this. Let's see if I can do this accurately enough. There we go. Okay. And so there's my put. Now look at long a call, short a put. If I combine those together, what does that look like? So here's what it looks like. I'll use this fancy multicolor thing here. It looks like that. Do you see that? If I combine those together, it looks like that. Wow. That looks almost like the payoff for a share of stock, but it's lower. It's too low, right? How much lower is it? Well, remember what was the slope of this down here? There's a slope of 1, right? So where is this going to hit down here? If I have a slope of 1, the strike is X right here. Where is this going to hit? Going a slope of 1, it's just headed down at 45 degree. Where's it going to hit? Minus X, right? Because this is that strike. I'm just going down at a slope of 1. I'm going to hit the y-axis at minus X, right? Where does this one hit? The red here, it's 0, starts at 0. So the only difference here is that, let's see if I can draw it this way. This is too low. It's too low to be the share of stock. How much is it too low? X. Yeah, it's X too low. So if I could take this curve and if I could raise it up, just a parallel shift everywhere by X, I would perfectly match the share of stock. Does everybody see that? It's too low by X everywhere. So if I could just add X, how do I add X? How do I add X to this payoff? Is there anything that we know that is just like a constant? What the bond? The bond's just a constant. So all I have to do is I just have to add a bond. And a bond is going to shift this up. Okay, so that's what I'm going to do. I'm going to adding a bond is buying a bond. Buying a bond with payoff what? How much did I need to shift it up by? X, the strike price. So that corresponded exactly to this here, right? This is just this. It just adds X everywhere. And that's exactly what I wanted. So what have I shown? I've shown the following. So this is my payoff diagram. I showed the following. I showed long a call. I bought the call, right? Long the call. Short a put. How do I represent short a put? Remember that coefficient tells you how many of them you're purchasing. I'm short a put, so I got a -1 in front of the put. That's why the minus sign. Right? Plus what? A bond. What is the payoff function of a bond? Well, it's just X. It's just a constant. It's just X. And that has the same payoff, exactly the same payoff as the stock. Okay, let's write that down in words here. So I am long a call. Okay. And here I'm short a put. And here I'm just going to say I'm long a bond. That means I bought the bond, long a bond with face value. Oh, I shouldn't use FB because people are going to think that's future value or something, right? I don't want to use P either because I have a put. I'm just going to write it out with face value equal to X, right? And that is equal to 1 share of the stock, right? So I'm almost done then. So that says these two things, both sides here, they have exactly the same payoff. So they must have the same price. I just need to price the two sides. So let me price these two sides, okay? Let me make a good. So what is the price of the call? C0. That was our price of a call. That's the call premium. What's the price of the put? P0. What is the price of a bond, a risk-free bond with face value X? Oh, I got to calculate present value. That's why we did present value. X over 1 plus R to the T. T was time to expiration. So that's the price of the left side of the equation. What is the price of the thing on the right side? That's just a share of stock. Just put the price of the stock. Boom, I'm done. Two things that have the same payoff must have the same price. I just price them, and there you go. There's my put call parity. All right. So this is the first big result that people came up with. They realized, wait a second, calls and puts, they can't be priced independently. If I know one, then at the same strike and expiration, I actually know the value of the other. Let's do an example of this. Let's plug in some numbers. Called example 1 in this chapter. All right. So we're done with the proofs there. There was our formula. Okay, so let's assume the stock price is, let's see, S0 is equal to $40. So we got a stock selling for $40. The risk-free rate. So now the risk-free rate is going to come into play. Okay, so we're always going to have to reference a risk-free rate because the bond was part of this portfolio. We earn interest on the bond. That's the risk-free rate. So that risk-free rate is going to come into play. So the risk-free rate is 8%. And I'm always going to use that annual compounding. So when I tell you 8%, that's 8% with annual compounding. Nothing tricky there. And time to expiration T is equal to 3 months. Okay. If there's a call, with premium, let's say $2.78. Okay, and I need to tell you the strike with X equal 40. So this is an at the money call. Okay. What must be the price of a put with the same expiration and strike? Okay, how are we going to solve this? We're going to use put call parity. So our answer, use put call parity. And what does put call parity say? So by the way, it's probably good to memorize put call parity. I never memorize it. The only thing that I memorize is those diagrams in my mind. So if you get really good at the diagrams, I think a call, short a put, oh, that's a straight line. Oh, it's too low, shifted up by a bond. But anyway, so put call parity says a call minus the price of a put plus the price of that risk-free bond, whose face value is the strike, must be equal to the price of the stock. Okay, so let's just plug in some of the numbers. So the call premium, we're talking about the premiums here. It's C0. The call premium is 278 minus P0. P0 is what I don't know. I don't know the put premium. What was the strike? The strike is 40. 1 plus the interest rate. The interest rate is 8%. Time to expiration is 3 months. We're measuring time, always measuring time in years, right? So that's 3/12, a quarter of a year. Okay, and that must equal to 40. So I have this equation. I'm going to solve for the price of the put, $2.02. Okay, everybody okay with this? When I give you the next homework, you're definitely going to have a number of put call parity problems. Like I said, this is sort of the big result from this chapter is put call parity. All right, so we're going to have to add some stuff onto this when we look at dividends or whatever. But first, what I want to do is I want to step back and I want to give you some of the terminology that goes along with an argument like this and its absence of arbitrage. And I'll give you some of the sort of bigger picture of what's going on here. So let's step back for a second and see just the argument that we did. Basically, we did an argument that said two things with the same payoff must have the same price. That was our argument. Okay, and that relates to what we call pricing by no arbitrage. Are you guys familiar with the concept of arbitrage or that word? It's a good word for finance people. I like the word arbitrage. I don't know why. There's this other professor that I talk to a lot, and he loves the term arbitrage, and he always talks about arbitragerial thinking. Like that's kind of a tough word, but it's like you've got to use arbitragerial thinking. So anyway, it's a good word to throw out there. Sounds impressive, right? Always good to use impressive sounding words. Okay, so what do we mean by arbitrage? Okay, so what is an arbitrage opportunity? Why should we price by no arbitrage? An arbitrage is, we're going to define it here. I'll define it a little bit loosely here, but this captures the main notion. It's a situation in which one can generate, this is going to seem kind of abstract, but I'm trying to give you sort of the more abstract picture of what's going on here. Generate a positive cash flow either today or in the future. So positive cash flows just mean I get money, okay? So that's always good. You want to generate a positive cash flow, but here an arbitrage says you can do that with no net investment, and it's got to be no net investment or risk. Okay, and so if you read that and you think about it for a second, what you find here is like that sounds way too good to be true. Okay, so I can generate a positive cash flow, I get money, but I don't have to have any net investment and there's no risk. Wow. So that's too good to be true. So you can think of in general an arbitrage opportunity, something that's too good to be true. You just make money, you don't even have to have any net investment. And you will often have people say an arbitrage I don't know if this is helpful, but you actually see this a lot. An arbitrage is a free lunch. Okay. And what does the phrase go? There's no such thing as a free lunch, right? So that's what I say. An arbitrage is a free lunch, shouldn't exist in markets. There's no such thing as a free lunch. All right. And what we use here is we use absence of arbitrage we're going to call that AOA for short. When I say I'm going to use an argument that this is an absence of arbitrage argument. So absence of arbitrage pricing assumes that arbitrage, sorry, my handwriting is sloppy, arbitrage is not possible. Right? That's that notion. There's no such thing as a free lunch. All right, let's talk about an arbitrage, a practical arbitrage. And in practice, what it usually boils down to is to another concept, which is an example of absence of arbitrage. And it's called the law of one price. So let me capitalize one here. So law of one price. What is the law of one price? It says, just like our argument for put call parity was, it says two portfolios with the same payoff must have the same price. That was the argument I used for put call parity. I said, hey, long a call, short a put, long a bond has the same payoff as a share of stock. Therefore, their prices must be the same. Two things with the same payoff must have the same price. Let's see how that relates to absence of arbitrage. Very, very simple argument. So how we can understand how these are connected. If the law of one price is violated, arbitrage is possible. Okay, let's see if we can think our way through an example of how you would arbitrage off of this. So law of one price says if it's violated, it says the following. So there are two portfolios. And when I say a portfolio, I'm just generically talking about, some trading strategy, right? So in the other case, one was just buy a share of stock and the other one was long a call, short a put, and long a bond, right? So here's what I have. Here's my setup. I've got portfolio one and I do its cash flow diagram. And if I do its cash flow diagram and I look at its payoff at time t, I'm going to call this P sub T1. That's the payoff from my first portfolio. Now this is a little bit confusing because I used P for put before, but here I'm doing it related to portfolio one. And then portfolio one has, again, this is the way my convention for doing these cash flow diagrams is a negative arrow for if you have to pay something. So there's a price there that you would pay for portfolio one. Okay. And then I have portfolio two. Portfolio two, what do we have here? Let me go down so that this matches. We're talking about exactly the same time. And it has a payoff. Okay. And there's some price, it has some price. It's going to be minus P02. And so let's assume the following. Let's assume we have a violation of the law of one price. So what would that mean? So the law of one price would say, let's say these two payoffs are equal. Okay. The payoffs are equal, but let's assume they have different prices. So that payoff function, if I graph it, like we do with calls and puts or whatever, they're exactly the same, but let's assume these prices are different. So just to make it concrete, let's assume that the price of portfolio 1 is less than the price of portfolio 2, okay? How can I arbitrage? Any ideas? How would I arbitrage off of this situation? How can I go in and do trades to just basically get a free lunch, just to make money, no net investment? What would I do here? Portfolio 1, they have exactly the same payoff, but portfolio 1 is cheaper than portfolio 2. What's the arbitrage? So I'm going to buy one. So here's my arbitrage. I'm going to do two things. What am I going to do? I'm going to buy. So what I always think is they have the same payoff. So, but P1 is the cheap one. P2 is the expensive one. What do I want to do in markets? There's only one rule of markets at the end of the day. Buy low, sell high. Buy cheap, sell the one that's expensive, right? That's it. No other rules. You're done with your finance degree. Buy low, sell high. That's it. No, but it does all come back to that. So what am I going to do? I'm going to buy the cheap one. I'm going to buy low, buy the cheap one. So I'm going to buy for the cheap price. Because remember, it's the same thing that I'm buying. They have the same payoff. So I'm going to buy for the cheap price. That's P1. And then at the same time, what am I going to do? I'm going to do an offsetting position. I'm going to sell for the expensive price. Buy what's cheap, sell what's expensive. Buy low, sell high. Buy for the expensive price. Or sorry, sell for the expensive price. I want to sell what's expensive. How does this arbitrage? Let's look at my, from this, let's look at my net cash flow stream. Net. Okay, so let's do a net cash flow stream where when I say buy and sell, basically I'm long and short. Let's look at my net cash flow stream. Let's draw the picture over here. We're out of time, capital T. Here's time 0. So position 1, I'm going to make this the red. I'm going to make this one the green so we can actually see it in the diagram. So let's do the red. So I bought for the cheap price. So what is its payoff? It's P sub T of 1. And how much did I pay for that? So minus P01. So that was my buying P1. Then what did I do? I sold, you can think of this as going short, P2. So what's that going to be? It's going to be that, because I sold it short. And when I sell short, I get the money up front. I get the price up front. Everybody okay with that? So I'm long one, I'm short the other. What is my net cash flow stream? So my net cash flow stream, when I net these out, let's draw it right down below. What happens at time capital T? And what do you get at time 0? Time capital T, there's nothing, because these two equal each other, right? They had the same payoff. I'm long one, I'm short the other, just net out. Nothing there, right? What happens at time 0? At time 0, what do I get? I get P02 minus P01. I just get this one's positive, this one's negative, which is greater than 0 because P02 was the expensive one. P01 was the cheap one. So this is my net cash flow stream. This is an arbitrage, right? A cash flow stream where the only thing that happens here is, hey, I make money. I never have to, there's no negative cash flow. I never have to spend any money. Everything just nets out and just money flows to me. that's an arbitrage, right? That is an arbitrage. Okay. So I'm out of time here, but this is a good stopping point. So what we're going to do is we're going to use this thinking. We're going to go back and say, hey, put call parity. We use the law of one price. If put call parity is not satisfied, then there should be an arbitrage opportunity. I should be able to buy and sell things and just make money. So we're going to explore that, right? And this is going to be the mechanism in markets. Put call parity is not satisfied. Somebody can make money. Somebody can arbitrage off of that. All right, next time I'll go over the exam. I apologize again for making you guys wait, but next time we'll quickly run through the exam just so everybody can see how they did. Oh no, I'll also do this. Yeah, I think we can go through it pretty quickly. I hope, but.